Realty Income just reported their most recent quarterly earnings, and they were great in my opinion. So what we're going to do today is look at Realty Income's business. We're going to be looking at their most recent quarterly results, and then we will be looking at why I think if you possibly bought Realty Income today, it could lead to market-beating returns in the ballpark of 15% plus per year for the next 5 to 7 years. So if that's some content you would be interested in listening to, I encourage you to watch this video. Give me a thumbs up if you like it and subscribe to the channel. So without further ado, let's go and dive right into the video. So Realty Income, if you're unfamiliar with the business, is a global leader in the fragmented net lease sector. So they essentially rent out specific properties to tenants, and then they do that on a net lease basis. So they have size, scale, and quality. So they're worth roughly about $56 billion in enterprise value. They've been in operations for roughly 54 plus years. They have 13,282 commercial real estate properties. They collect roughly $4 billion in annualized base rent, or ABR, and they have a strong credit rating from the credit rating agencies being Moody's and S&P. Now, roughly 40% of their rent comes from investment grade clients. So when we look at their portfolio or their real estate portfolio, they claim that it is diversified, and we'll be looking at that in detail in a minute. So they have 77% here in non-discretionary, low price point or service-oriented real estate, 15% in non-retail, and 9% in other. Now again, they state 91% of their total rent is resilient to economic downturns and is isolated from growing e-commerce pressures. So they have a growing international presence. They're the 7th largest global real estate investment trust, $9 billion European portfolio, which is only growing, roughly 354 assets there in Europe, and they have a WALT, or a weighted average lease term, of roughly 10 years, and their clients operate within 38 industries. So Realty Income, they consider themselves the monthly dividend company. They actually trademark that as well, and they have all the right reasons to do that. They've been paying dividends, consecutive dividends, as also rising dividends for 29 years. So 640 monthly dividends declared, 104 consecutive quarterly dividend increases, and they have increased them over this past 29 years at a compound annual growth rate of 4.3%. All right, so let's go and look at what industries Realty Income's clients operate into. So it's a nice mix here and pretty well diversified, as they stated. I also believe that they have some great industries to which they lease their properties or their tenants operate into. So roughly 11% in grocery, 10% in convenience. They have 7 and 6% in drugstores and dollar stores, home improvement at 6%, restaurants roughly at about 10% here. Then we have automotive services at 4%, health and fitness at 4%, and general merchandise here at 3%. So I really like this in terms of diversification. And like they said, their tenants are economically resistant to recessions. And again, looking at these top categories like groceries, convenience stores, dollar stores, drugstores, home improvement, and restaurants, again, people are going to need these services all the time. So I'm pretty comfortable here in terms of their tenants and who they lease to, as well as their financial operations. So that was the overview of Realty Income if you're unfamiliar, but now let's go and dive right into their most recent quarterly earnings that they had for the period ended September 30th, 2023. So net income available to common shareholders was roughly $233 million, or 33 cents per share. Now, when we're looking at REITs, or real estate investment trusts, net income is a lot less relevant metric. What we want to look at is FFO, or funds from operations, and AFFO, which is adjusted funds from operations. So normalized FFO was roughly $739 million, or $1.04 per share. Now AFFO was $721 million, or $1.02 per share. And we're going to look at these compared to the prior periods just for context in a minute. So they achieved same store rental revenue growth of 2.2%. So this right here is kind of what I was looking for in this report. I wanted to see how their same properties would perform in terms of rental revenue, and 2.2%, that is great rental revenue growth for having same stores. They didn't have to get any new properties to achieve this growth. This was same store rental revenue growth. So a great point here in my opinion. Now their net debt to annualized EBITDA, I also wanted to see how this ratio was, and it's roughly in line with previous quarters and their historic norms at 5.2%. So great here, in my opinion. Now, they did have a significant event subsequent to this quarter. So on October 29th, they entered into a merger agreement where they're going to acquire Spirit Realty in an all stock transaction, and that's going to close in the first quarter of 2024. So I did make a video on this. I'll leave a link in the description of this video, and I'll leave a link in the top right hand corner, and I encourage you to check that out. But essentially, I believe that this acquisition will be beneficial and accretive to Realty Income owners. They've also stated that it will add another 2.5% of annual AFFO moving forward. So again, I think that this transaction, it might be seen as a negative because it's an all stock transaction, but Realty Income, their management, and with their skills that they possess, I think it will actually be very beneficial to owners of Realty Income or stockholders over the long term. So that was the overview or the highlights of the earnings report. Let's go and look at the actual numbers. So this is for the quarter ended currently and the 9 months ended currently. And then this is for the previous years in the same quarter and the same 9 months. So total revenue, $1 billion compared to 837 million. So again, a nice uptick quarter to quarter and same as 9 months to date. Now again, net income, like I said, is not the end all and be all with REITs. As you can see, the net income per share did decrease, and that is expected with REITs because they issue shares in order to gain funds to further fund their acquisitions of specific properties and then increase their cash flow or their funds from operations. So what we want to look at is their funds from operations per share and their adjusted funds from operation per share. So their FFO per share was $1.04 for this quarter compared to 97 cents per share in the previous year's quarter. So again, a nice uptick here. And their AFFO per share following in line at $1.02 per share compared to 98 cents per share in the previous quarter. And year to date for those 9 months, $2.99 per share compared to $2.92. So that's a nice steady growth rate, roughly about 3% AFFO growth per share. So nice slow and steady growth here for Realty Income. I really liked these earnings. It showed their ability to operate in this tough macroeconomic environment, just chugging along here. So let's go and look at why I think that they could possibly present a large annual return opportunity here in the ballpark of 15% plus per year. And again, they actually communicated this slide right here. So this is a great slide. Now, when we look at this, we need to understand how companies return capital and return actual shareholder return to us as holders of their stock or investors. So it's usually made up of a dividend, a capital appreciation, and that gives you your total return. So here they state they've had roughly a 4 to 5% dividend yield. That's been their historic norm. But now when we look at Realty Income, as I believe they're heavily undervalued right now, and their stock price, if you can look over the past 5 years, it's at an all-time low. They now trade at a dividend yield on a forward basis of roughly 6%. So going back to this slide, this dividend yield here is now at a higher percentage of 6%. And they've achieved annual AFFO per share growth historically of 4 to 5%. Now, going forward, I don't think it's going to be aggressive as 5%. I think it'll roughly be in the 3 to 4% range, but still, that gets you anywhere from a 9 to 10% operational return. So again, that is my baseline thesis here. Now, when you add in Spirit Realty's acquisition that's going to happen in the first quarter of 2024, that's another 2.5% of return or AFFO per share growth. So that is going to lead to about 12.5% here, in my opinion. So it's going to outperform what they have listed here. And then looking at their actual price for AFFO or the valuation, it's at a 12. So if we go and look at Realty Income's actual chart here, we can see over the past 5 years, like it's at an all-time low. They actually used to trade somewhere around here in the 17 times AFFO on a forward basis. So trading at 17 times, they're actually down to 12 now. So once this valuation actually normalizes, which I believe it will, I don't think interest rates will stay this high for that long. And I know they may be higher than historic interest rates have been in the past decade, I'm not going to argue with that, but I don't think they're going to stay this restrictive for that long. I believe that they'll probably end up around a 15 to 16 times AFFO, close to that valuation. And just through that expansion there on the multiple, that can lead to 15, 16, 17% annual rates of return, according to their previous presentation here, and assuming that all goes right with what they have communicated to us as shareholders. So that was the video. I hope you enjoyed it. Please leave any comments or questions in the comment section below. I will do my best to get to them. And if you like it, give it a thumbs up and feel free to check out the rest of my channel. So thank you for listening. I hope you have a great day. Bye. Please note, I am not a financial advisor by any means. This content was made merely for entertainment purposes only. Please do your own due diligence when investing. Investing is inherently risky and you may lose money. I am not responsible for any investing decisions or losses you may incur. Thank you. Hope you have a great day. Bye.